What backs the US dollar? If you said gold, you're wrong. If you said the government, you're still wrong. The dollar isn't backed by anything tangible. It's backed by debt, by oil, by military power, and by a system so complex that most economists don't fully understand it. Today, we're going to break down exactly how the dollar works, from its creation to its global dominance, and why the system is far more fragile than most people realize. Welcome back to Past to Profit, where history meets money. The US dollar is the most powerful currency in human history. It's used in over 80% of international transactions. It's the reserve currency for central banks worldwide, and it's the foundation of the global financial system. But how does it actually work? Where does it come from? What gives it value? And most importantly, what happens when the system that created it starts to break down? To understand the dollar today, you need to understand what it used to be. For most of American history, the dollar was backed by something real, something you could hold in your hand: gold. From 1792 until 1971. With some interruptions, the US dollar was tied to gold in various forms. Sometimes citizens could exchange dollars for gold directly. Sometimes only foreign governments could. But there was always a link, always a promise that paper money represented real metal stored in a vault somewhere. The most important iteration of this system was the Bretton Woods Agreement. Established in 1944 near the end of World War II, representatives from 44 countries met in Bretton Woods, New Hampshire, and created a new global monetary system. The US dollar would become the world's reserve currency, and every dollar would be backed by gold at a fixed rate of $35 per ounce. Other currencies would peg their value to the dollar, and foreign governments could exchange their dollars for gold at any time. This system worked brilliantly for America. The rest of the world needed dollars to conduct international trade, which meant they needed to buy American goods, hold American bonds, and keep dollars in their reserves. The United States could print money to fund its economy, its military, and its global ambitions. And as long as the world trusted that those dollars could be converted to gold, the system held together. But trust is fragile, and by the 1960s, that trust was cracking. The Vietnam War was expensive. The Great Society programs were expensive. America was spending far more than it was producing, and dollars were flooding the global economy. Foreign governments, particularly France under Charles de Gaulle, started demanding gold for their dollars. They did the math and realized there wasn't enough gold in Fort Knox to back all the dollars in circulation. The promise was breaking. On August 10, 1971, President Richard Nixon went on television and announced that the United States would temporarily suspend the convertibility of dollars into gold. Temporary, he said. 53 years later, that temporary suspension is still in effect. Nixon didn't just close the gold window, he severed the last link between the dollar and anything physical. From that moment forward, the dollar became pure fiat currency, money backed by nothing except government decree and collective belief. So what backs the dollar now? The answer is more complicated and more interesting than most people realize. The dollar is backed by four things: debt, energy, military power, and network effects. Let's break down each one. First, debt. The US dollar is essentially an IOU issued by the Federal Reserve, which is technically a private institution but functions as the central bank. When the Federal Reserve creates money, it does so by purchasing assets, PRIMARILY, US Treasury bonds, which are government debt. This means that every dollar in circulation is backed by a corresponding amount of government debt. The more debt the government issues, the more dollars can be created. This is why the national debt and the money supply tend to grow together. They're two sides of the same coin. Second, energy. After Nixon ended the gold standard, the US needed something else to anchor the dollar's value. In 1973, Secretary of State Henry Kissinger negotiated a deal with Saudi Arabia. The Saudis would price all their oil sales in US dollars and invest their oil profits in US Treasury bonds. In exchange, the US would provide military protection and advanced weapons. Other oil-producing countries followed suit, and the petrodollar system was born. Now, if any country wanted to buy oil, the most essential commodity in the modern world, they needed dollars. This created artificial global demand for the currency, even without gold backing it. Third, military power. The dollar is backed by the most powerful military in history. When countries have tried to move away from the dollar for oil sales, the results have been brutal. Iraq under Saddam Hussein started selling oil in euros in 2000. 2 years later, the US invaded. Libya's Muammar Gaddafi proposed a gold-backed African currency to replace the dollar for oil transactions. NATO intervened in 2011, Gaddafi was killed, and Libyan oil went back to being priced in dollars. Iran has tried to build non-dollar oil trading systems and faces crippling sanctions. The message is clear: challenge the dollar system and you risk American military or economic retaliation. Fourth, network effects. The dollar is valuable because everyone else uses it. International contracts are written in dollars. Commodities are priced in dollars. Central banks hold dollars as reserves. The SWIFT system, which facilitates international bank transfers, operates primarily in dollars. This creates a self-reinforcing cycle. The more people use dollars, the more useful dollars become, which makes more people want to use them. Breaking out of this network is extremely difficult, even for large countries. Now let's talk about how dollars are actually created, because this is where the system gets truly strange. Most people think the government prints money, and technically that's true for physical cash. The Bureau of Engraving and Printing produces paper bills, and the US Mint produces coins. But physical cash represents less than 10% of the total money supply. The vast majority of dollars exist only as digital entries in computer systems, and they're created not by the government, but by commercial banks. Here's how it works. When you take out a loan from a bank, let's say a $50,000 car loan, the bank doesn't take $50,000 from someone else's account and lend it to you. The bank simply types $50,000 into your account. That money didn't exist before. The bank created it, out of nothing, the moment they approved your loan. In exchange, you sign a promissory note agreeing to pay back $50,000 plus interest over time. The bank now holds that note as an asset on their balance sheet, and the $50,000 you received is a liability. But from your perspective, you have real money you can spend. This is called fractional reserve banking, though the term is somewhat misleading because in practice, modern banks don't even need reserves anymore. Traditionally, banks were required to hold a certain percentage of their deposits as reserves, usually around 10%. If a bank had $1 million in deposits, they could lend out $900,000. But in March 2020, the Federal Reserve reduced the reserve requirement to zero. Banks can now create as much money as they want through loans, limited only by capital requirements and demand for borrowing. Every loan creates new money. When you buy a house with a mortgage, the bank creates that money. When a business takes out a loan to expand, the bank creates that money. When the government issues Treasury bonds and banks buy them, new money is created. And when loans are repaid, that money disappears. It's destroyed. The money supply expands and contracts based on the total amount of outstanding loans in the economy. This leads to a critical insight. The modern economy runs on debt. If everyone paid off all their loans tomorrow, most of the money supply would vanish. There would be a catastrophic deflation, economic collapse, mass unemployment. The system requires continuous borrowing to function. That's why interest rates are kept low, why banks are encouraged to lend, and why governments run perpetual deficits. It's not a bug, it's the design. Now let's talk about the Federal Reserve's role in all this. The Fed doesn't directly create money for the government to spend. That would be too obvious and would likely cause immediate hyperinflation. Instead, the Fed creates money indirectly through a process that sounds technical but is actually quite simple. When the government wants to spend more than it collects in taxes, it issues Treasury bonds, which are essentially IOUs promising to pay back the borrowed money with interest. These bonds are sold at auction to banks, investment funds, foreign governments, and other buyers. If there aren't enough buyers, or if the government wants to keep interest rates low, the Federal Reserve steps in and buys the bonds itself using newly created money. Here's the process. The Fed creates a digital entry in its own account, essentially typing new dollars into existence. It uses those dollars to buy Treasury bonds from banks or directly from the Treasury. The banks now have new money in their accounts, money that didn't exist before. They can lend that money out, which creates even more money through the fractional reserve multiplier effect. The government gets the cash it needs to fund its operations. The Fed gets bonds that pay interest, and new money floods into the economy. This process is called quantitative easing when done on a large scale, and it has become the Fed's primary tool for managing the economy since the 2008 financial crisis. Between 2008 and 2022, the Fed's balance sheet expanded from less than $1 trillion to nearly $9 trillion. That's $8 trillion of new money created and injected into the financial system. Not through government spending directly, but through bond purchases. But here's the key question. If creating money is this easy, why doesn't the government just print unlimited amounts and solve all economic problems? The answer is inflation. When the money supply grows faster than the supply of goods and services in the economy, prices rise. Each dollar becomes worth less because there are more dollars chasing the same amount of stuff. Inflation is essentially a hidden tax on everyone holding dollars, and if it gets out of control, it can destroy an economy. The Federal Reserve's mandate is to balance these forces, to create enough money to keep the economy growing without creating so much that inflation spirals out of control. They do this primarily by setting the federal funds rate, which is the interest rate that banks charge each other for overnight loans. When the Fed wants to stimulate the economy, it lowers rates, making borrowing cheaper and encouraging more money creation through loans. When it wants to cool things down, it raises rates, making borrowing more expensive and slowing money creation. But this balancing act has become increasingly difficult. After decades of low interest rates and massive money creation, the economy has become addicted to cheap credit. Raising rates too much causes recessions, stock market crashes, and debt crises. Keeping rates too low causes inflation and asset bubbles. The Fed is trapped between two bad options, and every decision it makes has enormous consequences for billions of people worldwide. Now let's zoom out and look at the dollar's role in the global system, because this is where the mechanics become even more important. The dollar isn't just America's currency, it's the world's currency, and that creates unique dynamics. When the US runs trade deficits, which it has consistently since the 1970s, it sends more dollars abroad than it receives. American consumers buy foreign goods, and foreign exporters receive dollars in payment. Those dollars don't stay overseas as cash. They get recycled back into the US financial system. Foreign central banks buy US Treasury bonds. Foreign corporations invest in American real estate and businesses. Foreign banks hold dollars as reserves. This creates what's called the dollar recycling mechanism. The US prints dollars, trades them for real goods from other countries, and those countries send the dollars back by buying American financial assets. It's an extraordinary privilege. America gets real stuff, and the world gets paper, or more accurately, digital entries in bank accounts. This arrangement has allowed the US to run enormous trade deficits for decades without immediate consequences. But there's a catch, described by economist Robert Triffin in the 1960s. To be the world's reserve currency, the US must run deficits to supply the world with dollars. But running persistent deficits undermines confidence in the currency. The more dollars flood the global system, the less each one is worth, and eventually trust erodes. This is Triffin's paradox, and it's been building for 50 years. We're now seeing the consequences. Countries like China and Russia have been reducing their dollar holdings and conducting trade in their own currencies. The BRICS nations, Brazil, Russia, India, China, and South Africa, are exploring alternative payment systems to bypass the dollar. Central banks worldwide are buying gold at the fastest pace in decades, suggesting they're diversifying away from dollar reserves. Saudi Arabia, the cornerstone of the petrodollar system, let its exclusive dollar agreement with the US expire in June 2024. They can now sell oil in yuan, euros, or any currency they choose. This doesn't mean the petrodollar is dead, most oil is still priced in dollars. But the monopoly is breaking. The SWIFT system, which the US uses to enforce financial sanctions, is also being challenged. Russia was cut off from SWIFT after invading Ukraine in 2022. And China has developed its own alternative called CIPS. If countries can conduct international trade without needing dollars or SWIFT access, the US loses one of its most powerful tools of global influence. Here's what most people don't understand about the dollar system. It's not just an economic arrangement, it's a geopolitical one. The dollar's dominance allows the US to impose sanctions, freeze assets, and essentially weaponize access to the global financial system. When the US freezes a country's dollar reserves or cuts them off from SWIFT, it can cripple their economy without firing a shot. That power has been used repeatedly against Iran, Venezuela, Russia, North Korea, and others. But every time the US weaponizes the dollar, it gives other countries a reason to find alternatives. The more Washington uses financial sanctions as a foreign policy tool, the more Beijing, Moscow, and others invest in building parallel systems. It's a slow process, but it's happening. Now let's talk about what actually gives the dollar value on a day-to-day basis. Because this is where theory meets reality. The dollar has value because people believe it has value. And they believe that because they can use it to pay taxes, buy goods, settle debts, and store wealth. This is called fiat currency, from the Latin for let it be done, meaning it has value by government decree. But belief is surprisingly durable as long as the system functions. As long as you can go to a store and buy food with dollars, as long as your employer pays you in dollars, as long as your debts are denominated in dollars, the currency works. The system is self-sustaining through collective agreement. The danger comes when that collective agreement breaks down. History is full of fiat currencies that collapsed once people lost faith. Weimar Germany in the 1920s, Zimbabwe in the 2000s, Venezuela in the 2010s. In each case, the government printed too much money. Inflation spiraled out of control and people fled to other currencies or hard assets. The money became worthless not because of any fundamental change in the paper or numbers, but because people stopped believing in it. Could this happen to the dollar? In theory, yes. In practice, it's far less likely than with smaller currencies because the dollar has structural supports that others lack. The US economy is the largest in the world. The US military ensures no external threat can force a currency change. The petrodollar system and reserve currency status create constant global demand. And most importantly, US government debt is considered the safest asset in the world, which means there's always demand for dollars to buy that debt. But these supports aren't permanent. If US debt grows, too large if inflation stays too high for too long, if oil is no longer critical to the global economy, if China or Europe or a coalition of countries creates a viable alternative, the dollar's dominance could erode. It wouldn't happen overnight. It would be a gradual shift, taking years or decades. But the direction is becoming clear. Let us talk about one more critical mechanism that most people have never heard of, the repo market. Repo stands for repurchase agreement, and it's the plumbing of the financial system. Every night, banks and financial institutions that have extra cash lend it to institutions that need short-term funding, usually overnight. The borrower provides collateral, typically Treasury bonds, and agrees to buy them back the next day at a slightly higher price. That price difference is effectively the interest rate. The repo market moves trillions of dollars every single day, and it's essential for keeping the financial system liquid. Banks use it to balance their books at the end of each day. Investment funds use it to finance their holdings. The Federal Reserve uses it to implement monetary policy. When the repo market froze in September 2019, briefly sending overnight rates above 10%, the Fed had to inject hundreds of billions of dollars to prevent a financial crisis. Most people never heard about it, but it was a warning sign that the system is more fragile than it appears. Now let's dive deeper into how the Federal Reserve actually conducts monetary policy, because understanding this reveals just how precarious the entire system is. The Fed has several tools at its disposal, but the primary ones are open market operations, the discount rate, reserve requirements, and forward guidance. Open market operations are the Fed's main tool. This is when the Fed buys or sells Treasury bonds and other securities to influence the amount of money in the banking system. When the Fed wants to increase the money supply, it buys bonds from banks, paying with newly created dollars. This gives banks more reserves, which they can lend out, creating even more money through the multiplier effect. When the Fed wants to decrease the money supply, it sells bonds, taking dollars out of circulation. The discount rate is the interest rate the Fed charges banks when they borrow directly from the Federal Reserve. This almost never happens in normal times because banks prefer to borrow from each other through the repo market or federal funds market. But during crises, when banks are afraid to lend to each other, the Fed's discount window becomes critical. The stigma attached to using it has lessened since 2008, but it's still seen as a sign of desperation. Reserve requirements used to be a key tool, but as mentioned earlier, they were reduced to zero in March 2020. This means banks theoretically have no limit on how much money they can create through lending, constrained only by capital requirements and the Basel III international banking standards. Capital requirements are different from reserve requirements. They mandate that banks hold a certain amount of equity capital relative to their risk-weighted assets. This is meant to ensure banks can absorb losses without collapsing, but it's a much less stringent constraint than traditional reserve requirements. Forward guidance is the Fed's newest and perhaps most powerful tool. This is when the Fed communicates its intentions for future policy to influence market behavior today. If the Fed says it plans to keep rates low for years, businesses and consumers will borrow more now, expecting cheap money to continue. If the Fed signals rate hikes, markets adjust immediately, even before rates actually change. The Fed essentially manages expectations, and in modern finance, expectations often matter more than reality. But here's what makes all of this particularly interesting. The Fed is not a government agency in the traditional sense. It's a hybrid entity, part public and part private. The Federal Reserve System consists of 12 regional Federal Reserve banks, which are technically owned by private member banks. The Board of Governors in Washington, D.C. is a government agency, but the regional banks are private corporations. Member banks are required to buy stock in their regional Fed bank, and they receive dividends on that stock. This structure was intentional. When the Federal Reserve was created in 1913, there was deep suspicion of central banking in America. The compromise was to create a system that was independent from direct government control, but also served public purposes. The result is an institution that's accountable to Congress but operates with significant autonomy. The president appoints the Fed chair, but can't fire them or dictate policy. Congress can change the Fed's mandate or structure, but rarely does. This independence has allowed the Fed to make unpopular decisions when necessary, like raising rates to fight inflation even if it causes a recession. But it also means the Fed operates with limited transparency and serves the interests of the banking system it's supposed to regulate. Critics argue this creates a conflict of interest. The Fed is run by and for bankers, and its policies tend to favor financial institutions over ordinary people. Now let's talk about something that almost never gets discussed: the Eurodollar market. These aren't euros, despite the name. Eurodollars are US dollars held in banks outside the United States, originally in Europe but now worldwide. This market is enormous, potentially larger than the domestic US money supply, and it operates entirely outside Fed control. Here's how it works. When a Japanese company sells products to an American buyer and receives payment in dollars, those dollars don't necessarily come back to the United States. They might stay in a Japanese bank, or a British bank, or a Swiss bank. Those offshore dollars can be lent out, creating more dollars through the same fractional reserve process that happens domestically, but without Fed oversight or regulation. The Eurodollar market emerged in the 1950s as the Soviet Union and other countries wanted to hold dollars for trade but didn't want to keep them in American banks where they could be frozen for political reasons. European banks started accepting dollar deposits and making dollar-denominated loans. The market exploded, and by some estimates, there are more dollars circulating outside the United States than inside it. This creates a paradox. The Fed controls the domestic money supply, but it has no direct control over the vast pool of offshore dollars. When global credit conditions tighten, the Fed can inject dollars domestically, but it can't easily get them into the Eurodollar system. This was a major problem during the 2008 crisis. Foreign banks couldn't get dollars, and the Fed had to create special swap lines with other central banks to provide dollar liquidity globally. The existence of the Eurodollar market also means that dollar creation isn't limited to what the Fed does. Private banks around the world are creating dollar-denominated credit, expanding the effective money supply beyond what any single authority controls. This makes the system more flexible but also more unstable. Let's also examine the role of Treasury bonds in more detail, because they're absolutely central to how the dollar functions. US Treasury bonds are considered the safest asset in the world. Safer than gold, safer than any other country's debt, safer than any corporation or bank. This perception, whether justified or not, is what allows the US government to borrow trillions at relatively low interest rates. When you buy a Treasury bond, you're lending money to the US government. In exchange, you get a promise that the government will pay you back with interest. These bonds come in different maturities. Treasury bills mature in less than a year. Treasury notes mature in 2 to 10 years, and Treasury bonds mature in 20 to 30 years. The interest rate varies based on maturity and market conditions, but the principle is the same. It's a loan to the government. The Treasury bond market is the largest and most liquid bond market in the world, with over $30 trillion in outstanding debt. Every day, billions of dollars worth of treasuries are bought and sold. This liquidity is crucial. It means the US government can always borrow more money, and investors can always sell their bonds if they need cash. No other country has a bond market with this combination of size, liquidity, and perceived safety. But there's a darker side to this. The US government is addicted to borrowing. The national debt has grown from less than $1 trillion in 1980 to over $34 trillion today. That's a 34-fold increase in 44 years. Interest payments on that debt now exceed $1 trillion per year, making it one of the largest items in the federal budget, larger than defense spending in some years. As debt grows, so does the risk. If interest rates rise, the cost of servicing that debt rises dramatically. If foreign buyers lose confidence and stop purchasing treasuries, the government would struggle to finance itself. If inflation stays high, the real value of the debt erodes, but so does the value of the dollar. There's no easy solution. The government is locked into a cycle of borrowing, spending, and refinancing that can only end in one of three ways: perpetual low rates and inflation, a debt crisis and default, or a massive economic restructuring. Now let's address digital currencies and their potential impact on the dollar system. Central bank digital currencies, or CBDCs, are being explored by countries around the world, including the United States. A CBDC would be a digital version of the dollar issued directly by the Federal Reserve, bypassing commercial banks entirely. This would fundamentally change how money works. Right now, most dollars exist as entries in commercial bank databases. Banks create money through lending, and the Fed influences but doesn't directly control that process. Every citizen could have an account at the Federal Reserve instead of at a private bank. The implications are staggering. The Fed could implement negative interest rates by automatically deducting money from people's accounts, forcing them to spend rather than save. It could track every transaction in real time, eliminating financial privacy. It could program money to expire if not spent by a certain date, or restrict how it can be used. The level of control would be unprecedented. Proponents argue a CBDC would make the financial system more efficient, reduce transaction costs, and give the Fed better tools to manage the economy. Critics warn it would create a surveillance state and give the government dangerous power over individuals. China has already launched a digital yuan and is using it to monitor and control economic activity. If the US follows, the nature of money and freedom would change permanently. But CBDCs also pose a threat to the dollar's global dominance. If China's digital yuan becomes widely used for international trade, it could undermine the dollar's reserve currency status. If the European Union launches a digital euro, it could provide an alternative for countries that want to reduce dollar dependence. The race to develop CBDCs is as much about geopolitics as it is about technology. Finally, let's talk about what happens if the dollar system breaks. Not a collapse tomorrow, but a slow erosion of dominance over the next 20 to 50 years. History shows that reserve currencies don't last forever. The British pound was the world's reserve currency for over a century, from the Napoleonic Wars until World War II. Then it was replaced by the dollar. Before the pound, it was the Dutch guilder. Before that, various currencies tied to gold or silver. The transition from one reserve currency to another is usually messy. It involves wars, economic crises, and political upheaval. The shift from pound to dollar happened during 2 world wars and the Great Depression. The next transition will likely be similarly chaotic. If the dollar loses reserve status, the US would lose the ability to borrow cheaply. Interest rates would rise, making the national debt unsustainable. The government would be forced to cut spending dramatically or raise taxes, both politically toxic. The standard of living would fall as the US could no longer import more than it exports and pay with printed money. It would be painful, but not necessarily catastrophic. Other countries manage without reserve currencies. For the rest of the world, the impact would be equally significant. Countries holding trillions in dollar reserves would see their wealth eroded. Global trade would need to find new mechanisms for settlement. A multipolar currency system with the dollar, euro, yuan, and perhaps others sharing reserve status could emerge. Or a completely new system based on digital currencies, or even a return to commodity backing could develop. The dollar system as it exists today was built for a world that no longer exists. A world where the US was the undisputed superpower, where oil was unquestionably critical, where alternatives to dollar-based finance didn't exist. That world is fading. The mechanisms that keep the dollar dominant are still functioning, but the cracks are widening and the pressures are building. Understanding how the system works is the first step to preparing for what comes after it. So here's the bottom line. The US dollar functions through a complex web of mechanisms. Debt creation by banks, money printing by the Federal Reserve, the Petrodollar system, reserve currency status, military backing, and network effects. It's a system built on confidence, on the collective belief that these digital entries and pieces of paper have value. And for now, that belief holds. But the system is under stress. US debt is over $34 trillion and growing. The Federal Reserve's balance sheet is bloated. Inflation has returned after decades of relative stability. Competitors are building alternatives. And the geopolitical environment is more fractured than at any time since the end of the Cold War. The dollar won't collapse tomorrow, and it may not collapse in our lifetimes. But the era of unquestioned dollar dominance is ending. The mechanisms that made it the world's reserve currency are being challenged, and the privileges that came with that status are eroding. What replaces it? Whether that's a multipolar currency system, a digital currency, or something entirely new remains to be seen. But one thing is certain, the hidden mechanics of how the dollar functions, the debt creation, the petrodollar, the reserve system, were never designed to last forever. They were solutions to specific historical problems, and like all human systems, they'll eventually be replaced by something else. Understanding how the current system works is the first step to understanding what comes next. If this gave you a new perspective, hit subscribe. History has the answers, and on Path to Profit, we'll show you where to look.